So Laura, let's go ahead and let's get started. So what is a bridge loan and who does it benefit?
Okay, so a bridge loan or bridge line of credit is typically on your primary residence. It's an interim financing. So this is for when somebody's looking to purchase a new home but hasn't sold their existing property. They can put a line of credit on their existing residence.
Okay, so it's basically an ideal loan product for somebody looking to buy and sell at the same time.
Right.
Perfect. Now,
well, I was going to say, you as a real estate agent, when you get offers, and if you get an offer that's contingent on the buyer selling their existing home, how do you feel about that? Is that as strong of an offer when it has that contingency?
No, and that's why I wanted to bring you on the show, just because it's not. The reality is, let's say I have 5 offers on a property. 4 of them are not selling a property, and 1 of them is selling a property. Even if the one that is selling a property is higher down payment, sometimes because they have that contingency, meaning there's another property that things can go wrong on, meaning it can fall out of escrow, it may not appraise, the inspection contingency may not go right. It just adds a certain level of risk, which makes that offer less desirable. What it sounds like is that this product is specifically to help somebody in that way to be able to get the house that they want and not be looked at as a weaker offer because they're contingent upon selling their property. So how would that work? Meaning how does it work?
So I'm going to use some just basic numbers to keep this as simple as possible. So if your home is worth $1 million and you have a loan for $200,000, you've got a lot of equity in that home. So the bank will come and we can do a bridge line of credit for up to 80% loan to value. That's up to $2 million property value. It goes tiered after that. So that way you could use the equity in your home. We will pay off the existing first mortgage. Your new payments are interest only. So this allows you to then go into a contract to purchase another property and not have the contingency that you sell your home. In fact, when you go into that new purchase agreement, the seller's agent, nobody needs to know because you have your financing in place. And along with the bridge line, we can also do the pre-approval for your new home as well. So it's really
you guys basically handle the entire thing. So in that example, let's say it's $1 million, you can borrow or leverage up to 80%, which that would mean $800,000. There was a first loan of $200,000, so they have approximately about $600,000 in equity. What you're saying is that they can use that equity as a down payment. They can use some of it or all of it if they wanted to purchase the next property. And that's all done on the back end, meaning that once that gets done, they can make an offer non-contingent on that property.